Good afternoon, everyone, and welcome to the webinar. And many thanks for joining us. My name is Paul Dell. I'm a partner here at Raffingers, and I head up our Raffingers Wealth Management joint venture. We deal with all areas of financial planning, wealth management, including protection, mortgages, equity release, investment management, pensions, retirement planning, estate planning, and private client work like trusts, etc. I'm joined today by Laurence Daly, one of our wealth management consultants here, and Peter Marsland from Octopus. Peter's going to talk to us for most of this. I'll let Laurence introduce himself and then hand over to Peter.
Thanks very much, Paul. Hi, I'm Laurence Daly. I work as a financial planner for Raffingers Wealth Management. So I deal with Raffingers clients when it comes to all aspects of their financial planning. Raffingers Wealth Management is a joint venture with Tavistock Private Clients, and we look to do holistic financial planning for all of our clients, which means basically everything from basic investment planning to retirement planning through protection planning, as Paul has indicated. Right now, I suppose we're entering the end of the tax year, and a lot of people will be looking for some ways to get some tax relief. And one of the most, I suppose, one of the more attractive ways for some of Raffingers clients in terms of getting tax relief would be venture capital trust, because this tax relief can be applied to rental income, dividend income, so it's not as restrictive as pensions, which are only limited to your net relevant earnings or your taxable income. So with that in mind, I'm going to hand over to Pete. He's going to walk you through some of the ways in which Octopus are one of the leading, they're the leading group really in this whole area, one of the largest VCTs in the country. So without further ado, I'll hand you over to Pete.
Cheers, Laurence. Thank you very much. Hello, everybody. Like you said, my name's Peter. What you need to know from the bio there is that I've worked for Octopus now for 8 years. Why is that relevant for you? Why is this going to be important to you today? Well, twofold, really, like Laurence was alluding to. We'll be talking through venture capital trusts. We'll be talking about enterprise investment schemes. And what they both have in common is, first of all, they allow you to do some really, really interesting tax planning. So it's a good way of getting some tax back, perhaps access some tax-free growth as well. I'll explain exactly how that all works. But at the same time, you get to back some of the most exciting and brightest businesses around in the UK at the moment. So businesses that we really hope could go on to be household names for the future. So I'll be talking about some of the companies that we've backed previously. These are businesses like Zoopla that you'll know about, Kazoo more recently as well, which are multi-billion pound companies that you can get into at a very, very early stage, and of course could potentially generate some very, very good returns. So I'm going to start sharing my screen here. So make sure I click on the right button and not do what I just did there. So click yes to changing screen. And I'm going to switch over to this. I'm hoping that you can all see that right now. I'm just going to maximize that on the screen as well. So hopefully you can see that. So yes, so thank you for joining us for today. Before we get underway, just a really, really quick thing to mention about what we're going to be talking about. So we're investing in startup businesses. So these tend to be unquoted companies. They're very early stage businesses. They tend to be pre-profitable. And as a result, this is very, very important. Everything that we're going to be talking about is high risk. That doesn't mean you shouldn't use it. It doesn't mean it's not going to work very, very well for you. But you need to bear in mind that you may not get necessarily back what you invest originally. And sometimes the investments don't go so well. Thankfully, we've got a good track record. To date, they have gone well. And it's certainly worth speaking to Laurence, to Paul as well, and making sure that if you are looking to go into this area, that you do seek advice about it. Because ultimately it comes down to whether you can afford to do it, what proportion, how long you need to allocate that money for. But just bear in mind that these investments are always going to be considered to be slightly higher risk. Now that's out of the way, what are we going to be talking about? Well, what I'm going to do is I'm going to start with actually quite a lot of the basic information. I'm going to talk quite generically around venture capital trusts, what they are, why they exist, the sort of tax planning situations that you can use them for. Then I'm going to repeat that process for enterprise investment schemes. So again, just looking at what they are, why they exist, and again, they're going to be used in slightly different circumstances. Then at the end, I'm going to be talking a little bit around Octopus Ventures, and of course, there's a room for a little bit of a Q&A at the end as well. But to start with, because I'm assuming many of you won't know who we are, just a little bit of a snapshot around us as a company. So who are Octopus Investments? Well, first and foremost, we're just an investment firm. But really, we're specialists. So what we do is we've been around since the year 2000, and we specialize in tax-efficient investments. So that's investing, it's really problem-solving investment. So the one thing that tax-efficient investments got in common is all about government legislation trying to direct money and investment into companies they want people to invest into. So there are two key areas that we deal in that. So first of all, we do lots of investments into trading companies. These are businesses that qualify for something called business relief that will provide an inheritance tax benefit. So we're the largest provider in that market. So we do lots of investments into things on the alternative investment market, various other products as well. We'll park that for today because I'm assuming that most of you are a little bit younger. Hopefully you don't have to think about that for a long time. The other side of the business is all about getting money to startups. And the government has obviously provided two really huge tax wrappers to allow that to happen. So one is venture capital trusts. Again, we'll be talking about that. The second one is enterprise investment scheme, or EIS, as I'll probably refer to it throughout. And that's all about directing money to startup businesses that we think are going to shoot the lights out and provide some really big tax benefits there. And again, we're the largest provider of those types of investments as well. So we was founded in 2000. We've grown to be about 12 billion under management. You're probably more familiar with our sister company now. So our sister company we set up 5 years ago is Octopus Energy. So again, I wouldn't be surprised actually if some of you actually use Octopus Energy, or if you support Arsenal, something like that, you'll see us all over the Emirates. So that's probably more of a household name than we are. So all of that's quite interesting, quite impressive. It's quite nice to be the leader in any market you're actually operating in. But it only really tells half the story. So part of the process is what you do. The other part of the process is how you do it. Everything that we do at Octopus Investments is about responsible investing. So they're really, really strict criteria. And what you can see on the screen there is it says Certified B Corp. Now, I don't expect many of you to actually know what that is. Maybe some of you do. But really, it's the fair trade stamp for businesses. It means that we're not evil. It means that we're trying to do the right thing. We're trying to put people before profit. There's only about 700 of them in the world globally. Companies like Patagonia, companies like Ben & Jerry's. There's actually only 4 asset managers that are certified B Corp, and we're one of those 4. So we really are at the forefront of everything that we're doing. So it's all about green investing. It's all about sustainability. In fact, the venture capital trust that we've actually recently launched is the first sustainability rubber stamped VCT in the market. So there's nothing else like it at all. So the whole purpose of that is based around sustainability. This just gives a snapshot of some of the assets that the breakdown by our assets under management. We've got nearly 11 billion under management. You can see that about 2 billion of that is invested in just in startup businesses, either via EIS or via VCT. So this is where I turn it into a slightly different session. So this is going to be a multimedia, obviously working for a company like Octopus. You'd expect it to be at the forefront of technology. So what I'm going to do is I've got some pens and I've got a whiteboard, and I'm going to take you through about how these investments work, because I feel as though it works very, very well. Just to Charlie, I'm assuming I'm spotlighted for everybody. So I'm on the big screen. If you could double check that, I'd be really, really grateful. But I'm going to start off by saying, what is a venture capital trust? So venture capital trust, or VCT for short, is actually really, really straightforward. All it is actually just an investment trust. It's an investment trust that was set up by, sorry, just checking something there very quickly. It was set up by the government in the 90s, and it was there to try and encourage investment into small startup businesses. So they literally are investment trusts. They're just an investment company, like you'll find for any other investment company. They're listed on the London Stock Exchange. They're completely transparent. But of course, these have a slightly different mandate. And that mandate is, of course, to invest into small startup businesses. So every single year, they will look to invest that money into maybe 10 or 20 new companies, depending on the VCT. Okay, but these businesses, when we first invest in, that's what each of these circles actually represent. They have to be under a certain age, they have to be in specific sectors, certain number of employees, and provided that they fulfill those criteria, we can invest in them. The slightly more liberal criteria for knowledge-intensive businesses. So knowledge-intensive businesses are companies that the government recognise need a little bit more investment up front. They need to help them basically kickstart their growth. These are businesses that do extra research and development. These are businesses that have some sort of IP in place. They just need a little bit more money. We'll come back to that later because it's really, really relevant when we're talking about EIS, less relevant for this. So anyway, we're investing into these businesses. Every year we might be raising 30 million quid, 40 million quid, more than that, some of the other VCTs that we've got. And that money will be going into these businesses. They are, as startups, they're nearly always going to be pre-profitable when we go into them. What happens if some businesses are pre-profitable? Well, unfortunately, we know that some of those businesses have failed. Again, we've mentioned that these things are high risk. That company is going to be most vulnerable when you first invest into it. In the startup world, about 50% of all businesses will fail within the first 5 years. So astonishingly hard to get it going. I'm sure many of you are successful business owners yourselves. Therefore, you'll know how tricky that is. Thankfully for us, because we're picking the entrepreneurs and we're working with them on a day-to-day basis, supporting them, our failure rate is actually a lot lower than that. So our failure rate typically is about 1 in 5, about 20% of the businesses that we invest in will fail. So it's still quite high. We wouldn't want that to be much lower because otherwise we're not taking on board enough risk, really. So these things are always going to be deemed to be high risk. You do need to expect that some of the companies within that investment will fail, but of course the diversification you get within a VCT should be really, really helpful. However, the government knows that these things are going to be slightly higher risk, and as a result, what they will do is they'll say, well, actually, we want you to invest in these businesses, and to compensate for this, we're going to give you a nice big tax incentive on the way in. So they give you 30% income tax reduction on the amount that you invest that you can offset against your income tax. In other words, if you invest £50,000 in 1 year, that means you can reduce your tax bill by £15,000 provided you've paid it. You get one certificate through, it comes a couple of weeks after you've invested, and then you can use that you can do a self-assessment, or you can just send it off to HMRC, and you can reduce your tax bill by a corresponding amount. The other thing to note is that it's not actually just for earned income as well. It's actually also relevant for people who have dividends. It's also relevant for people who have buy-to-lets. So if any of you have got buy-to-lets, you can use that. You can use a VCT to offset that. So anything that you pay income tax on. That's the most famous tax incentive that you're going to get from a VCT. However, there are two other ones that you're going to receive. So the first one is you're going to get tax-free growth. So when you sell these shares, there's no capital gains tax to be paid. And the other one is tax-free dividends. So a VCT will pay out a dividend if it's performing well, not guaranteed, but these things are pretty decent targets. For example, all of ours will target a 5% dividend per annum. If that dividend gets paid out, that's also going to be completely tax-free. So you can see how efficient that is. Normally dividend tax, to find an equivalent yield on that, once you add on the tax above it, you'd be looking for about 7 or 8 or even 9%, depending on what your tax band is. So nice way to remember this. You've got tax-free growth, you've got tax-free dividends coming from a VCT. They're exactly the same benefits that you would receive from a Marsland. But of course, remember that the actual underlying investment is going to be very, very different compared to what you normally have within a nice wrapper. So those are the main tax benefits you get from it. I'm just going to take that one step further. The other things you need to know, the maximum you can do in any one tax year is £200,000, but the average case size is actually a lot lower than that. The actual average case size actually only sits at around about £20,000. So people do these little and often. They might do one every single year and then start revolving them. So I'll talk about that in a minute. The other thing you need to know is that you need to hold on to these investments for 5 years. Okay? You can sell them before 5 years, but if you do, you give up your 30% tax relief. So people tend not to do it. So you have to consider this as a long-term investment. Something, if you speak to Paul and Laurence about, you need to know that this is money that you've got to have capacity for loss for, and it's going to be locked away for the medium term at the very least. That's what advisors know. I just want to take it one step further with you, just so you understand exactly how these work. Okay, because this is the essence of what was going on in venture capital. So we've got to go and find those businesses every single year. There's no list. We have to go and source those businesses through our networks, through trade conventions and things like that, through universities. We look for the best entrepreneurs with the best ideas in huge markets, and if we like it, we will look to invest in that business. When we invest in that businesses, we know that they're going to nearly always be at a very early stage, and they're nearly always going to be pre-profitable. If they are pre-profitable, how on earth can we pay out 5% regular dividend? Well, it's like this. It's not in the same way that you might from a normal investment trust, where the companies might pay dividends themselves. It's going to be done like this. Investing in venture capital is a partnership. So we'll be taking a big minority stake of that business, maybe 20%, maybe 30%, investing a few £1 million when we first go into it. But we'll be taking a seat on that board, and we'll be working with that business day in, day out. So we've got a team of 70 that sit within our ventures team. I'll talk about them at the end of what they do, but they've got all manner of expertise. They've run businesses themselves, they're lawyers, they've management consultant backgrounds, they've got investment management backgrounds. So we're there to really help that business grow and work with them day in, day out. We know some of them will fail, but they won't all fail. And those businesses that are doing very, very well, we'll look to back them again. So you'll look to back your winners and build your stake or maintain your stake in that business to avoid you getting diluted. And our responsibility is to really grow that business from when we first invest down here, all the way over this period of time to a point in time where they become attractive to an external party. So perhaps an Amazon will come in, or a Google, or a Microsoft, or a Twitter. We've sold businesses to all those companies. So they'll come in, they'll buy that business, the money will flow into the VCT, and that is the cash that will be used to pay out a dividend. There's an oversimplification, there's more things going on in that, but that's the idea. We get into them as early stage businesses, we keep investing in them, we work with them on a day-to-day basis, we get them to this point, maybe perhaps next year it's this business that's sold, the money flows into the VCT, and then it pays out a dividend. So that is how VCTs work. At this point, I normally say any questions. Clearly, you can't hear from me at this point, so perhaps we can have some of them at the end, unless Paul or Laurence have any. But I'm just to talk about who exactly might use these businesses and in what situations. So typically, it's going to be wealthier individuals who use this. I mean, most clients, if they're not, most clients who are still contributing to an ISA or still contributing to a pension, probably less likely to be doing this. You'd normally tick those buckets before you start looking at VCTs because they are deemed to be slightly higher risk. But there are some really good, some key types of individuals who use them. The first one are any of you that are in a fortunate position to be earning lots of money. So if you're earning 6-digit figures, you're going to be paying a lot of tax. Perhaps you can afford to allocate a small proportion of your overall portfolio into a VCT. The second one is for any of you who are restricted by pensions. So hopefully you've been contributing to pensions, either through personal contributions or employer, and you've reached a point where you can no longer contribute. Now that might be because you've hit the annual allowance because you're paying too much money, or it might be because you've hit a lifetime allowance because you're capped at just over £1 million. That being the case, you might start thinking, well, actually hang on a minute, is there anywhere else tax efficient that I could look to invest in? And then that's when you might start looking at these areas. The next one I'd say is any of you who've got buy-to-lets. If you've got buy-to-lets, perhaps those portfolios are going to be, they're going to be paying out an income to you. Of course, that is just another form of income tax. You can use a VCT to get some of that back. And then the final idea, which is why I've sort of shifted weirdly over to this side of, I was going to say the stage, that really overstates it. But to the room, is to talk through this example. So I'm sure knowing Raffingers, I'm sure that many of you are going to be business owners. So if you are, perhaps this is your problem. It doesn't have to be business owner, the concept's the same, but it's just a good way to explain how this works. So let's imagine this bar chart. This demonstrates the profit that you are generating every single year from within your company. You're not going to get that out. How are you going to get that money out? Well, the first thing you might do is pay yourself a small salary. And you pay yourself a much larger dividend at the same time. The reason you might do that is because you've got extra tax efficiencies for doing that. Reduced national insurance contributions, that sort of thing. But that dividend and that salary, that represents, that's your lifestyle income. That pays for everything you want to do, from a day-to-day expenditure all the way through to holidays, to schools, whatever it is you want to spend your money on. You might, if you can, stick some money into a pension. Nice way to get it out of the business. You might choose to leave some money invested in the business, as well as a bit of a rainy day fund, or to continue pumping that back in. But often that leaves a little bit more sort of sat in the company that's not really doing an awful lot. And it might be, and there could be tax implications for that. There could be issues for the trading stages of the business. There could be issues for entrepreneurs relief as well. But I think the main problem there is really an opportunity cost. If it's sat within cash within the business, it's not really working for you, right? So the conversation could be, well, hang on a minute. If that's going to be sitting in the business, and it's going to be sat there for the foreseeable future, why don't we pay that out as an extra dividend? Could you pay that out as an extra dividend? It's what I refer to as a super div, just to differentiate it from this one down here. Now, you're going to be paying probably quite a large sum of tax. Higher rate is going to be 32.5%. Your additional rate will be 38.1%. But dividend tax is just another form of income tax. Therefore, if you pay it out and you invest that into a VCT, you're going to get 30% tax relief on it. But all of a sudden, it's only going to be 2% or 8% to get that money out of the business. Depending on the VCT that you're going to be going into, if it's a mature VCT like Titan, it might be paying out 5%, might not if it's like our Future Generations, which is brand new. I'll talk about those a bit later. But you could be getting a dividend there as well. But in other words, it's a much, much more cost-effective way of getting money outside of a business. Then that works very, very well. You've got to hold on to that investment for 5 years. Of course, it's got to stay within all the parameters of your overall portfolio and things like that. Again, this is the importance of advice. But let's see what happens if you repeat that process. And this is the essence of planning with VCTs that you should sit down and speak to them about. Could you afford to do a little bit every single year? So you do it in year 1, and then you say, actually, hang on a minute, let's repeat that process. Another super dividend, invest that into a VCT in year 2. So you get another tax relief, hopefully getting another dividend at the same time. Then you do it in year 3, you do it in year 4, and then you do it in year 5. So every single year, another dividend gets paid out of the business, gets invested into a VCT. Every single year, you're getting tax relief. Hopefully, you're getting those dividends every single year as well. Why have I done it 5 times? Well, I've done it 5 times because you've got to hold on to a VCT for 5 years. So when you get to year 6, you don't need to do that same process again. What you could do is you could say, well, we've held this original one now from year 1. This one, we've held it for more than 5 years. What we could do is we could look to sell that. If we sell that original VCT, you release the proceeds, and you can invest that in year 6. That gives you further tax relief, something that you've already had tax relief on. So you get another 30% a year. And what that means, so you could use that tax credit to offset paying that super dividend straight into your pocket every single year, 2.5% or 8.1%. So it becomes self-funding. Year 2 goes into year 7. Again, you're paying that straight into your pocket. So it becomes a self-fulfilling way of getting money outside of the business very, very quickly. I talk about this as profit extraction from a business. It doesn't need to be. So you can use this for just normal income tax if you just want to reduce your income tax on an ongoing basis. It's just a nice way of using a diagram to explain it. But this is a corridor we see so many people using these days. So doing it little and often, perhaps doing 20,000, 40,000, whatever it is you want to be able to afford or look away into it, and then just repeating that process. You've got a whole portfolio of VCTs doing it for you. The reason you're using a VCT here is because it's an investment trust. So the investment trust is a more liquid vehicle. It's listed on the stock exchange. When we come to exit, we can facilitate a buyback. Liquidity is not perfect because the underlying investments themselves are actually unquoted, but it's been pretty good. We've never had any trouble facilitating liquidity historically. We tend to deal with them on a monthly basis so that you, outside of accounting periods, but it becomes a pretty easy way to be able to start circulating VCTs. So again, if this seems like your type of problem, do sit down with Laurence, do sit down with Paul and talk through some of those ideas. So that's a VCT. I'm going to switch over to the other side, and I'm going to talk you through a different way you can access startups, which is via enterprise investment scheme. So you can see me here. So an enterprise investment scheme is actually, I'll do it in this bit here so you can have the VCT next to it as well. So a VCT is a fund, okay? So when you're buying exposure to a VCT, you can get exposure from anything from 20 to 40 to 100 companies.
Hi, Pete. Sorry to interrupt you. I see Jerome's got his hand up there on the. So I don't know if Jerome wants to ask a question or.
Yeah, go ahead, Jerome, if you can. I don't know how we do this.
Can you hear me?
Yes, I can.
It's actually Jerome's son. I'm replacing him, asking a question. Hi. I missed the bit, if you talked about it, about what have been the returns on the actual investment, rather than just focusing on the tax savings. Totally, if I'd invested money, what actual return would I had on the investment? Quite
exactly. No. You haven't missed it at all because I haven't come onto it. I was going to come onto that at the end when we talk about ventures, but really good question. To give you an idea, so Titan VCT, which is our flagship VCT, it's actually the flagship VCT in the industry. It's 1.3 billion pounds in size. It's got 100 companies in it. Over the course of the last 5 years, it's done 45%, and then you've got tax relief on top of that as well. If you access it in different ways, you get if you access that via an EIS wrapper, it's going to be very different returns to that. But I'll cover that when we come to the end. Hopefully that answers your question. Cool. So on EISs, so again, just focusing on the wrapper, I'll come to the products a little bit later on. So what is an EIS? Well, if that's a fund and you're getting access to loads of companies inside of it, what you're going to get access to here is that one company. An EIS is actually just a direct investment into a startup business. So it's a very different mechanism of getting money into it. Now, of course, we're not going to be complete nutters. We're not just going to invest that money into one company. That wouldn't give you enough diversification. What we're going to be doing is we're going to be building your portfolio over around about, say, a dozen companies. So just for the avoidance of doubt, that's an Octopus. We'll be investing that money into about 12 businesses, a process that will take a couple of months to go about doing that, typically 6 to 9 months to actually build a full portfolio. But every single company that you go into is early stage. If you're going into a mature VCT, you actually get exposure to these big companies at the same time as you do as well as the new companies. So it's a very different wrapper for that reason. And for that reason, you actually get slightly more generous tax benefits. So the first one is you get 30% tax relief, but you can actually carry that back by 1 tax year. So if you invest into our current EIS, which is currently open, you can still get tax relief for the 2021 tax year, which is the only way you could do it these now. Otherwise, it's gone. You can't claim any tax back for it. But with an EIS, you can, but it has to be a very specific type of EIS that can deploy before the end of the tax year, or it has to be a knowledge-intensive EIS, which is what we're running, which is where you go into businesses that have slightly more R&D, require a little bit more investment up front, but you can carry that back to the 2021 tax year. So that's the first one. That's very similar to that. You've got the additional benefit carry back. The next one is two sides of the same coin, really. So you've got as you do with the VCT, you get tax-free growth. So they're CGT free when you sell them, but you also get loss relief on them. What that means is that you get uncapped upside. And if you're thinking about it, you're going into these businesses here when they're early stage. If those businesses go on to be really, really successful, so to cherry pick an example, the highest ever return that we've had from an investment we've got into is a company called Secret Escapes, which I'm sure many of you would have heard of. That business did 88 times return on its initial investment. So we got in at a very, very early stage. It was 2 people from previously, we worked with previously, and we backed them, we thought they were going to be a great business, and so they proved to be. So they were very, very successful. So we did 88 times return, all of that would have been CGT free. The other side of it, loss relief, how does that work? So loss relief is incredibly useful if these investments don't go so well. So this is how it works in practice. Imagine you've got, you invest £10,000 into a particular company. If you invest £10,000 into a particular company, you're going to get 30% tax relief. That means the net cost of the investment is going to be £7,000. Loss relief starts from that point. So if it goes down, all the way down to zero, you can offset the net cost of that investment at your marginal rate of income tax. So if you're an additional rate taxpayer, you can get 45% of 7,000. Or if you're a higher rate, you can get 40% of 7,000. In other words, you're going to get £3,000 back up front. And if you're an additional rate taxpayer, the maths work out that you're getting £3,150 back. So the maximum you can lose if you're an additional rate taxpayer is 38.5p in the pound. So it really caps the downside. Now, of course, we're not expecting all the companies in the portfolio to fail, but they could. It's very, very unlikely. But like I say, typically we think about 1/5 of companies will fail. Although, albeit every single portfolio will vary. Let me just grab this very quickly. That down. So the first tax benefit, just to reiterate, you get 30% tax relief, you get tax-free growth, you get loss relief on it. The other two tax benefits you get, which I won't talk about too long. First of all, you get business relief on them. What that means is they're going to be completely free of inheritance tax after 2 years if you pass away holding those shares. So it's just that if you are wealthy, you do have an inheritance tax liability, it's just a way to begin to chip away at your IHT liability at the same time. And the final benefit you've got is CGT deferral. So if you've had a large capital gain recently, you can actually park it in the value of these shares. Now, I won't talk about that in depth. That's something really to sit down with Laurence or Paul if you do have it. But you can park a gain in that. Do bear in mind that if the investment goes down or it goes up when you sell it, you are going to have to pay that CGT liability at a later date. Albeit in theory you could recycle it. So those are the key tax benefits. How's it going to work in practice? Well, it's going to look like this. The money would come to us. We can invest that money into a portfolio, like I said, around about a dozen businesses. It's going to take us 6 to 9 months to invest that. You've got to hold on to these investments for a period of at least 3 years. Albeit, you're with the gods. We're in that respect. We're actually completely responsible for when we sell those businesses. So we could sell them before. It's very unusual when we do that. It tends to be really, really good news, as I'll allude to in 1 second. It means that's shot up in value. We're not going to be selling it at a loss within 3 years, ideally. But it's going to look a little bit like this. So some of these businesses, as I've mentioned, they're not going to work. A couple of them, so maybe those businesses will fail. It's quite a proportion of businesses, companies that are failing within this portfolio. But what you really want is a handful of absolute superstars. You might have one company here which does 10 times return. You might have this business here which is sold before 3 years, but that's done 3 times return. It's done 3 times return. You're selling it. Yes, you have to relinquish your tax reliefs, i.e. this one, but you're getting a pretty decent return on it anyway. And then hopefully you've got 1 or 2 other companies within the portfolio that give you 7 times return, or whatever it is. And what we're really trying to do is we're trying to get to a point where, you know, you only need a couple of winners within a portfolio to actually cover the entirety of that cost. So I'm just going to show you a slide, going back to showing my screen again, of how that would work in practice. So this will bring it to life a little bit. So I'm going to go to, so hopefully you can see this. It's quite a busy slide, but I still think it tells quite a good story. Oh, hang on, let's come back to that one. Pardon me. There you go, this is the slide. So in this portfolio, this is a bit of a duff portfolio, this one. We've invested into 5 different companies, £10,000 has gone into each company. So you've had £3,000 worth of tax relief up front for every single one. That's obviously in your pocket up front. And then 4 of these businesses, company A to company D, have all gone down to 0. But as an additional rate taxpayer, you're going to get loss relief on those. So you're going to get at least 6,150, because remember, the maximum you could lose is 38p in the pound, 38.5p in the pound. And then, thankfully, you've got company E, and company E is successful. So company E has done 3 times return, and that's generated £30,000 plus the tax relief up front. And what that means is that you're actually in the black, even though 80% of that portfolio has failed. Now, we don't expect that to happen. It could happen. These things are high risk, just to reiterate that again. But in reality, we'd expect that there would be a handful of businesses within there that would be very, very successful. So that's how it helps. If you want to access, rather than having it within a fund where some of the returns might be a little bit more diluted because you're getting it all packaged up in one vehicle, if you want to access that explosive growth yourself, EIS might be the right wrapper for you, but it's down to have that conversation with Paul and with Laurence. And if you do that, this is something that I see happen quite often. You see, the wealthiest clients that I deal with, they'll be building a portfolio every single year for a number of years. There's going to be big variance in performance of how long those companies are held for. There's going to be variance about how successful those businesses are as well. But you get an idea. The more startups you invest in, the more likely that some of them are going to actually do extremely well for you. So into Octopus Ventures. So those are the 2 wrappers. I'm going to be talking about a little bit about what we're doing. So Octopus Ventures are our ventures team. So they sit within Octopus Investments. There's about 70 of them on that team these days. They're actually the 7th largest venture capital firm in Europe. So to put that into context, when they're looking for deals, it puts them quite close to the front of the queue. It means we're competing with companies like Accel or Index. Again, so Index, we won a business from under their noses called Comma recently. Comma do bulk payment systems, but Index were one of the companies that backed Facebook as a startup. So for us to actually win that business is a really massive, massive feather in our cap. So we could compete with those sorts of businesses. They've got about 2 billion under management now. The majority of that sits within a VCT called Titan VCT. So Jerome's son, that was the VCT that I spoke about a moment ago. So Titan is a big, mature VCT. It's been going since 2007. It's got 100 companies in it these days. It's backed companies like Zoopla, like Secret Escapes, like Kazoo, like Bought by Many, all these big businesses. And it's now the largest VCT in the market and one of the top performing ones as well. So that's their largest investment. But the other things that they run is they run a brand new VCT called the Future Generations VCT, which is the world's first sustainability focused VCT. Now that is brand new. It's actually got no companies in it whatsoever, but that's going to be looking to invest into companies that are building a sustainable future for the UK. And they also run the Ventures EIS, which is, of course, what we've just discussed in terms of wrappers. And that's accessing exactly the same deal flow, but via an EIS wrapper. Like I say, the teams of 70 people, they've got really broad experiences. You need that. You need that for the networks, the people that can introduce you, the entrepreneurs that they can introduce. You need that for the skills to be able to support those businesses as well. Because entrepreneurs are always going to be sat there thinking, actually, why the hell should I partner with you? Why shouldn't I partner with Index or with someone else? So you need that level of expertise. So that's something that we're really, really proud of. Over half the people in our team have actually run businesses themselves, so they know what it's like from personal experience. Otherwise, they do have quite technical backgrounds. Over a third of them have PhDs. But where we don't have the expertise, we'll actually hire it in. So we've got one guy, to give you two examples. One of the guys is one of the founders of PayPal. He sits and works with our businesses if we don't have those expertise. Likewise, we've got basically the lead specialist for floating businesses in the UK. He's floated companies like Boohoo, like Betfair, like Zoopla, and he works with those companies on a day-to-day basis if ultimately they're going to be looking to do a float. Likewise, rather uniquely for this area, for this sector, we've actually got a worldwide presence, but we're not looking for deal flow globally. All the businesses that we invest in will be UK-based. But we do have offices in Shanghai, we've got offices in New York and San Francisco, and we're there. They're there to basically help those companies with the sole objective of helping them expand into those markets. So that gives you an idea. What sort of businesses are we looking for? Well, we're looking for the brightest talent. So we're looking for really good ideas. We're looking for investments that we think can generate at least 10 times return on our initial investment. To be able to do that, those businesses have to have a competitive advantage. They have to have really, really good ideas, but crucially, they have to be in a multi-billion-pound market. If that market isn't multi-billion, and we don't think it's going to be in the future, we won't invest in that business because, frankly, the ultimate opportunity is curtailed by the size of that market. So we're looking for those businesses. For them to scale up quickly, we look for tech-enabled companies. So companies that build platforms in specific sectors. I'll give you examples of the sorts of things in a moment, but if they got, you don't back against tech. If you're looking for tech-enabled businesses, they're going to be able to ratchet that growth an awful lot more quickly. And finally, the most important thing on the far-hand side is we look for a talented and ambitious team. It's all very well, the other metrics, but ultimately what makes a business successful is the team that's behind it. Who might be good at running a business? Ultimately, a team that might be good at running a business is one that's done it before. So we like backing serial entrepreneurs. So one example of the businesses that we've backed, the first company that we backed is a business called Love Film. So Love Film, you might remember it was doing postal DVDs back in the day. It was actually a copy of Netflix, quite deliberately so, is what the CEO did. He liked what Netflix were doing, he brought it to the UK. You think that business has vanished, but it hasn't. It was actually bought by Amazon. And it was bought by Amazon for a small fortune. That's actually subsequently changed into Amazon Prime, which is why Amazon Prime is the TV service and also the super quick delivery service that they've got. That team spawned a number of other businesses. So one chap called Graham Bosher, who came out the back of that, he set up a subsequent business called Gray's. So you'll notice the Gray's snack boxes. That was originally a postal delivery business as well, selling human food through the post. That was bought by Unilever. When he's finished selling a business that sold human food, he came and thought, well, let's do one that does dog food. So he set up a business called Tails that was sold to Nestle for a small fortune. And we've backed him on his fourth business now. His fourth business is a company called Skin & Me. They're selling cosmetics through the post. Again, it's another delivery business, subscription service. Equally, from that Love Film team, you've got Secret Escapes. They came from that too. And then the final chap was a guy called Alex Chesterman. So Alex Chesterman was the CEO, the creator, the brains behind Love Film. He sold that. Then he tried to set up another business, which was called Zoopla. That was the first unicorn, the first multi-billion-pound business to come from a VCT. That eventually was sold for £2 billion to private equity. And then he came back and set up another business called Kazoo. So Kazoo is you'll all be familiar with it. They sponsor Aston Villa, they sponsor Everton. It's a second-hand car service. They recently did a float on the New York Stock Exchange for $7 billion. So incredibly successful entrepreneurs. And it means so much that these people want to come back and keep working with us on an ongoing basis. Just to note, actually, in terms of the success of the team, there's only ever been 116 tech startups in the UK. The Octopus Ventures team have actually had 7 of them. Sorry, from VCT and EAS funding, there's only ever been 7. Octopus Ventures have had 4 of those. So that's Zoopla, that's Kazoo, as I've already mentioned. but it's two other businesses. One's called Bought by Many and the other one's called Depop. Every year, because we're such a big player in the market, as you can see there, we see thousands of businesses. We whittle that down. We see about, we do a little bit more, some serious digging in about 300 of those. And then eventually we're investing, 50 is actually a little bit high. I think that includes follow-on rounds of funding as well. But typically we invest in about 30 new businesses a year. In the essence of time, I'll come to this. So what are some of the examples of the businesses that we've invested in? So I've talked about some of them. That's really, maybe you won't recognize all of them on the left-hand side, but you can see the companies that we're selling them to are all household names. You've got Unilever there, you've got Nestle there, you've got Microsoft there. So there's really good reason why entrepreneurs want to work with us, because they know we've done these exits before. We've done it time and time again. Really good story there is a company called Magic Pony. So Magic Pony was a bit of AI that sits on a device that makes it that's really able to work out what an image is supposed to look like, so you don't need very much detail to invest in that company. And we've actually backed a very, very similar business I'll talk about in a second later. But Twitter came in and offered for that business a few years ago. They were only 27 years old. They're straight out of Imperial College. They offered £30 million for that business. That business had never even turned a profit. Obviously, at 27, they said, actually, yeah, we could take those chips, we could do something with that. Ultimately, because we had a seat at the board, we said, actually, no. If Twitter are coming in with that level of offer, imagine what Google would pay. Imagine what Facebook would pay ultimately. So they agreed. They took on board our advice. They sat with it. 2 years beyond that, they actually sold to Twitter for $180 million. So it's so worth them waiting that little bit longer to be able to get that huge exit off the back of it. But it's such a great story about the value that we can add to those businesses. Don't all work. So obviously some of those businesses are going to fail. They can fail for a whole number of reasons. They can fail because we back the wrong team. They can fail because there's a change in legislation. Property partner, that was a way of buying. You could buy a share in a property, in a rental income producing property. But of course, when the legislation changed around rents, then of course that business model was really shot to pieces. Cabby, alternatively, Cabby was this genius idea that you could press 2 buttons on a phone and a cab would come and collect you, and then it would take you to wherever you wanted to go to. We really liked it because the team were very, very good, and there was another little small, tiny little business doing that in San Francisco. Well, no guesses who that business in San Francisco was. It was Uber. Within 3 months, they'd actually entered the UK and completely flooded the market already. So sometimes the time is a little bit off. But like I say, it is higher risk investing. Not all of these businesses are going to work out. In terms, I'm just going to come off sharing this way, and I'm going to share a slightly different option here, because those are businesses that we've invested in historically. Of course, we've also had the other unicorns this year. So Bought by Many is a big pet insurer. That is a business that has done. Let me just go on to here. So that's a business that has done. Pet insurer that's now the fastest growing pet insurer in the UK. It's just raised it's done a Series C funding round that values the business at 2.2 billion. It's expanding into the US. It's expanding into Sweden. It's really shooting the lights out in that industry. Likewise, we recently sold a company called Wave Optics to Snapchat. That's augmented reality specs. That was sold for $500 million. That was the largest ever deep tech sale in history. In European history. So really, really successful. So those are the businesses that we've historically backed that you can find out a little bit more information on. I'm just going to focus on 2 more final companies, which are recent investments, and then I'll hand it over. So the first one is a company called iSize. So iSize, normally you get taken to a slightly different website, which is, well, I'll talk about it anyway. But this is very similar to the business we backed previously, which is very similar to a company called Magic Pony. So it's a bit of artificial intelligence. It sits on a phone, and what it does is if you've got really, really poor quality reception, it can really jazz it up. It works out what it thinks it should look like, and it gives you a really, really crystal clear image. Now, that's a really, really clever idea. Obviously, you can see how that would be really useful if you are somewhere in sub-Saharan Africa or somewhere like that, and you have really poor quality data. or if you're an O2 and say you're in Hammersmith, then of course it can be really, really useful, and I can speak for that. So it's really useful if you have that on your phone. Why might this fit within a sustainability focused VCT? Well, it's to do with the carbon emissions. And this is a completely mind-blowing stat. But if you think about all the tablet devices worldwide, in terms of the data that they receive, sending and receiving, and in terms of the power that they're using to generate those screens, it actually uses more carbon emissions than the entirety of the aviation industry on an annual basis. So anything that's able to reduce the amount of data that needs to be sent, and therefore the amount of energy that a phone needs to use, is really, really positive. So that was a recent investment that we made in September. And this is one that's a little bit older than that. This is a company called Oleo. So Oleo is a business that's all about reducing food waste. So again, another carbon emission stat. Food waste is, if it was a country, it would be the third largest emitter of carbon emissions globally. So it's a huge problem. So this company just wants to go and reduce waste. But you know, originally set out by a couple of people who thought, wouldn't it just be wonderful if you just had some out-of-date hummus and you shared it with someone else down your street, and you know you're both on an app and you could just share that, and then you actually reduce the amount of waste that's there. Well, that's great. Because I think it's nice and virtuous thing to go and do, but it's not going to change the world. And secondly, it's not going to do, you know, it's a drop in the ocean in the grand scheme of things. So they thought, well, who else needs to reduce their waste? Well, restaurants do. Think about Pret. Think about Starbucks. Think about all these businesses that create so much food, and most of that would be going in landfill. These guys will now take that waste, and they'll get rid of it responsibly. They'll distribute it to whoever needs it, so it's not wasted. So that's where they make their money. They contracted it in that way. They've actually just taken on the CEO, the former CEO of Just Eat, who's hopefully going to take that business to the next level. So hopefully that gives an idea of some of the businesses. Like I say, in terms of the VCTs that we have open at the moment, so we've got Tapering VCT, which unfortunately is closed for the year so far. But we've sorry, there we go. It's Titan VCT, which is closed for the year so far. That's done its fundraise, £200 million. That's a very, very mature VCT. That's the one that's done 45% over the course of the last 5 years, plus of course the tax relief on top of it. So forget about that one for the time being. That'll open up next October. The two current fundraisers we've got, first of all, we've got a VCT, which is our Future Generations. That's our sustainability-focused VCT. That's doing a £20 million fundraise. It's raised £10 million already. Because it's small, because it's new, it's going to be a little bit higher risk than a mature VCT. It's not going to pay a dividend for the first 3-5 years. But at that point, it should be targeting that 5% return. So we're really counting on a bit more growth at that, capital growth on that one in the early years. So really, that's not an investment you're going to stick 200 grand in. It's something you're going to diversify with something else. But again, speak to Paul and speak to Laurence about that. The other investment that we've got is our EIS. So that's the Ventures Knowledge Intensive EIS. Again, we've raised about £12 million into that, a £25 million fundraise. It's the only way you're going to be able to get tax back for the 2021 tax year. So again, if that is something you're interested in, do go and speak to them and we'll take it from there. So just wondering if we have any questions there at all. I mean, Paul, Laurence, do you have any questions there at all?
Thank you, Peter. Very interesting as always. Just a couple of questions. What's the sort of minimum investment level we're talking about?
Great start. So it's £5,000 for a VCT because it's structurally very easy. So all you're doing is buying shares in an investment trust. For the EIS, it's slightly bigger ticket stuff. So the minimum investment there is £25,000.
Okay, thank you. And can you just recap on the ideal client for the VCT and EIS?
Yeah, exactly. So I would say
between the two, really.
Yeah, totally. So I would say, I mean, so ultimately it's down to what your attitude for risk is and what you can afford to do and what you want to go and do. In my view, and this is my view, I'd say you probably start off with VCTs to start with because they're slightly more liquid because you've got that extra wrap, you've got the investment trust there. So I think, you know, if I was an advisor, the clients that I would be looking for, and maybe this is some of you, I'd be looking for high earners who can, you know, can invest that money, lock it away for 5 years, and then can reduce their income tax on an ongoing basis by selling that and then recycling the investment, invest it again. Year 1 goes into year 6, year 2 goes into year 7, so on and so forth. You also people who've got pension restrictions, people who are paying a lot of receiving a lot of rental income as well. EIS is slightly different. So EIS, I would say, is for more adventurous investors. Now, if you invested in one of our unicorns, so one of the billion-dollar valuations, so one of those 4 I mentioned, you're going to get diluted in a VCT because there's 100 other companies in there, right?
Yeah.
If you're in an EIS, you just hold that alongside another 11 or another 10 companies. So you've got much more exposure to that. So if it wins, it can win very, very big. And of course, so if you can unlock that money and you're willing to take on board that risk, that can work quite nicely. But do bear in mind, you don't have the same level of liquidity within an EIS because it is an ongoing business, because you will be holding on to it for 5, 7 years, maybe even longer potentially. You know, we're in control of when we sell that, and we will maximise the investment returns for all of our investors, rather than focusing on liquidity.
Excellent, good stuff. Laurence, you got anything else to add to this?
Yeah, I just want to say that there's something here that I think is really important when it comes to looking at the investment into the VCTs as part of, let's say, an ongoing process of having a diversified range of investments. We have lots of listed market volatility going on at present. I mean, we have lots of macroeconomic and global geopolitical tensions happening. For some clients, when you think about it, if you want to have a basket of various assets working for you, the vast majority of our clients are going to have some property assets. They will have their pensions probably invested in some liquid assets. The benefits of both the combination of the tax-free dividends plus the tax-free growth for investing in, like, granted, it might be illiquid to a degree, but startup companies can be phenomenal in terms of the fact you can actually generate a money-making machine over time by more or less putting in, let's say, your 20,000, your 50,000 pounds per annum into your VCT, reinvesting the dividends while you're still in that accumulation phase, and then switching off the tax-free, the tax relief on the reinvested dividends when it comes time to retire, because you're going to get that income tax-free from those dividends regardless of your tax bracket. So there's no restriction on it. And that's something that a lot of my clients really love to have, which works complementary to the other streams of income that they're going to rely on when it comes to building up a retirement pot. And I think that's really important.
Completely. It's one of the things I did mention is that if you're going into retirement, these things can really supplement your income. So, because it's all tax-free, right? So it can, really means you might not need to take as much money from your pension and things like that.
Yeah. Good. Okay, guys. Thanks again for joining us today. Hope you found it useful. If you want any further information, then contact either myself or Laurence, details on the screen there, or your Raffingers relationship partner, and we'll be pleased to assist. So thank you very much, and goodbye for now.